Welcome back to another deep dive.
Good to be here.
Today, we're really digging into the recent earnings call transcript from Alibaba Group. This covers their March quarter and actually the full fiscal year 2025 results.
Yeah, quite a bit to unpack there.
Exactly. And our mission, as always, is to cut through the corporate speak, the dense numbers, and pull out the key nuggets of information and insight just for you, the listener.
Right. What were the real highlights? Any big strategic shifts? What does it all actually mean?
Let's jump right in. Maybe start with the top line results they kicked off with.
Okay, so for the quarter, total consolidated revenue was up 7% year over year.
Okay, 7%.
But they also gave an adjusted figure, excluding businesses they divested, like Sunart and In Time. And that number showed growth accelerating to 10%.
Right. So 7% reported, but maybe 10% like for like? Kind of.
Got it.
What about profitability?
That looked pretty strong. Consolidated adjusted EBITDA saw a significant jump, up 36% year over year.
36%. That's quite an increase.
It is. Net income was also up, though the GAAP number had some noise from changes in equity investment values.
Yeah.
They finished the period with a very strong net cash position too, around $50.5 billion equivalent.
Wow, okay. Over $50 billion in net cash. That's a substantial pile. But I noticed something on the cash flow side. Operating cash flow was up, but free cash flow seemed to take a big dive. Down 76%, I think. How did they square that?
Yeah, that was a sharp drop. They were very direct about it, attributed mainly to increased CapEx, capital expenditures, particularly big investments in cloud infrastructure.
Oh, okay.
So that huge cash pile gives them the firepower to make these large strategic bets they clearly think are critical for the future. It's like a very deliberate choice to invest heavily right now.
That makes sense. Investing for growth. So where are these investments actually going, and how are the different business segments holding up? Let's unpack those, starting with Alibaba Cloud. What did the transcript tell us there?
Right. Cloud Intelligence Group. Revenue growth was 18% year over year, or 17% if you exclude their own consolidated subsidiaries. Management really emphasized this as an acceleration.
An acceleration. And what's driving that?
The big driver they pointed to, public cloud services. And specifically, that growth is being fueled by AI.
AI again. Seems to be the magic word everywhere. How much of a factor is it really for their cloud business?
It seems huge. Management stated, get this AI-related product revenue maintained triple-digit year-over-year growth for the 7th consecutive quarter.
7th quarter, triple digits.
Yeah. They clearly see massive demand for cloud and AI as like a defining opportunity for the next decade or two. They acknowledged potential supply chain uncertainties, but they seem pretty confident that the underlying customer demand is solid and won't be derailed.
Okay.
And that conviction is why they're aggressively ramping up investments in AI infrastructure, advanced technologies, the whole package.
That level of sustained growth really underscores why they'd be investing so heavily. Did they talk about who is adopting AI beyond just the usual big tech players?
Yeah, and this was fascinating. They described AI adoption really broadening out. It's moving beyond just large enterprises now, filtering down into small and medium-sized businesses.
Okay.
And across a really diverse range of industries. So yes, internet services, finance, autonomous driving, but they also mentioned momentum in traditional sectors.
Yeah.
Even animal farming and manufacturing.
Animal farming using AI cloud services, that's specific. Gives you a picture. Did they give any big enterprise examples?
They did. They highlighted that the Industrial and Commercial Bank of China, ICBC, selected their PolarDB database. That's a major financial institution showing adoption in demanding sectors. It suggests this isn't just, hype for them.
Right. Real world uptake. And what about their own AI models? I saw something about open sourcing.
Absolutely. In April, they open sourced their Qwen 3 model family. By the end of that month, they'd apparently open sourced over 200 models under the Qwen name, with over 300 million downloads globally. That's a pretty significant contribution to the open source community.
Okay, so AI demand accelerating cloud growth, driving major investment, broadening adoption. How did all this impact cloud's bottom line, its profitability?
Well, adjusted EBITDA for cloud did increase year over year, which is positive.
Okay.
However, the margin actually decreased quarter over quarter, and management tied that margin pressure directly back to those increased investments, pouring money into customer growth, tech innovation, and especially building out that infrastructure, which means higher depreciation costs hitting the books right now.
So prioritizing growth and capacity over immediate margin expansion.
Exactly. Capturing market share, building for future AI demand seems to be the focus.
Okay, let's switch gears then. What about the core e-commerce engines? Taobao and Tmall Group, TTG. How did that segment shape up?
TTG revenue looks solid, up 9%. And customer management revenue, CMR, which is a really key metric for their e-commerce profitability, grew even faster, up 12%.
12% CMR growth, that's strong. What specifically boosted that? How are they improving monetization?
Management pointed to two main things. First, introducing that 0.6% software service fee on Taobao last September. Apparently, it was zero for many merchants before that.
Right.
And second, increasing the uptake, the penetration of Tong, which is their performance marketing tool. They said these efforts particularly help their white label and SMB merchants.
Interesting. So finding new ways to monetize the platform activity, especially for smaller sellers. What about user trends?
They mentioned ongoing investments in user experience and growth initiatives are paying off, leading to stronger momentum with new users and continuous growth in order volume.
Okay.
A key milestone they flagged and really emphasized wanting to retain was their 88 VIP members group. That surpassed 50 million people.
50 million VIPs, that's a huge base of valuable customers.
Definitely. And how did TTG's profitability look with all this going on, the investments, the monetization push?
Right.
Adjusted EBITDA for TTG was up 8%. So growth, driven by that strong CMR, but like cloud, partly offset by spending on user experience, tech, and other growth efforts.
Got it. Okay, moving internationally. Alibaba International Digital Commerce, ADC. That's been a big growth story for them. How did it do?
Yeah, ADC kept up its strong pace. Revenue grew 22%.
Wow.
Primarily driven by their cross-border businesses. And significantly, they reported a narrower operating loss and improved unit economics. They specifically called out progress in the AliExpress Choice business. That's the one focused on better selection and faster delivery for consumers.
Narrowing losses internationally is key. What's the broader strategy there, beyond just cross-border shipping?
They talked about actively diversifying, bringing in local merchants and local supply chains in different markets, not just relying on shipping everything from China.
Makes sense.
Management sounded pretty confident that having this diverse geographical footprint helps them navigate the dynamic local conditions in different countries.
Yeah.
And they set out a notable target, too.
Oh, yeah. What was that?
Achieving overall quarterly profitability for their international e-commerce business sometime in the coming fiscal year.
Really? Profitability for the whole international segment. That would be a major milestone.
Absolutely. A big goal they're aiming for.
Okay. Let's quickly touch on the other segments before we hit the Q&A. Any key highlights?
Sure. Digital Media and Entertainment Group, DME, actually hit profitability on an adjusted EBITDA basis this quarter, mostly thanks to Youku, their video platform, turning profitable.
Okay, good news there.
Local Services Group saw revenue grow year over year, and its adjusted EBITDA loss narrowed compared to last year. Though the loss did increase quarter over quarter, which they put down to seasonal factors and investments.
Right.
Cainiao, the logistics arm, saw revenue decrease, but that was mainly because it's being integrated more directly into the e-commerce operations. Its adjusted EBITDA actually increased.
Okay.
And the all other segment had growth from areas like Fresh Hippo Grocery and their health business, but that was offset by deconsolidating Sunart. And this segment is also seeing ongoing investment in, strategic AI initiatives.
Okay, that covers the main segments. We find the Q&A part of these calls often gives the juiciest details, right? Insights into management thinking and priorities. What stood out from the analyst questions?
Yeah, definitely. A big theme, especially around cloud, was really drilling down into that AI monetization and adoption story we talked about. Management doubled down, basically.
Right.
Very strongly stated that AI demand is the fundamental reason for that recent acceleration in cloud growth.
And did they elaborate on how that AI adoption actually translates into cloud dollars? Like the mechanics of it?
They did. They explained that the need to actually develop and run AI applications gives companies a really compelling reason to move workloads onto the cloud, even companies that traditionally kept things in-house.
Right.
So this migration isn't just about basic storage or compute anymore. It's specifically being driven by the heavy infrastructure needs of AI models and applications across all sorts of sectors.
And there was talk about different sizes of AI models, wasn't there? Small ones versus big ones.
Yeah, an analyst asked about that. Management clarified their view. Smaller edge models, the kind that might run on your phone or, a smart toy, they see those as often complementary. They might still drive users to need cloud resources for related tasks like data processing or maybe using a larger model sometimes. But it's the larger, more complex AI models that are the primary drivers of that big cloud infrastructure demand, just because of the sheer computing power needed. And those are best run on the cloud for scale and cost efficiency. Management seemed pretty bullish, expressing quite strong confidence and conviction in the cloud revenue growth path for the next few quarters.
Confidence in the trajectory. Okay, staying with AI, but switching back to e-commerce. Did analysts probe how AI is being used there?
Oh yeah, definitely. Management sees huge potential. They talked about using AI to improve the user experience, things like better search results, more personalized recommendations.
Standard stuff, but important.
Right, and also increasing advertising efficiency for merchants. They said they're actively piloting these kinds of applications and starting to see positive results. Longer term, they even hinted at potential for totally new ways for users to interact with the platform powered by AI.
Interesting. Okay, another key area for analysts was that TTG monetization strategy. We mentioned the new fee and the marketing tool, QZBT. Did they ask about what comes next? Any more levers to pull?
They did push on that. Management was clear, though. Number one objective is stabilizing or growing market share. They're going to see the monetization rate is flowing from the size and health of that market share.
Right, market share first.
But they did confirm that last year's moves, the 0.6% fee boosting QZT adoption, significantly improved monetization, especially helping out those smaller white label merchants.
So was that it for monetization improvements, or is there more planned?
No, definitely more planned. Management explicitly called it a multi-year initiative.
Ah, okay.
Future levers they mentioned include potentially rolling back some of the introductory rebates they offered on that 0.6% fee over time, which would naturally increase the effective take rate.
Gotcha.
And also continuing to push for wider adoption of Chanchuantong, the marketing tool, to bring in more advertising revenue, especially as new merchants come onto the platform and start using these tools. Plus, they said they'll keep innovating and piloting new models, including ways to leverage AI for monetization too. So, yeah, definitely an ongoing focus.
Okay, multi-year effort there. Going back to cloud quickly, an analyst asked about the growth pace during the quarter. Was that 18% growth steady throughout?
Good question. Management clarified that the January to March quarter includes the Spring Festival holiday, which always kind of messes with seasonal comparisons.
Right, the holiday effect.
They highlighted that the really rapid growth pace they saw after the Spring Festival ended, specifically in April and May, is probably a better indicator of the kind of regular growth rate they expect going forward.
And what's driving the post-holiday surge?
Mostly AI inference workloads, they said. So not just training the models, but companies actually using the deployed AI models day to day, which chews up a lot of computing power.
I see. Okay, a huge point of discussion, and clearly investment, was instant commerce. An analyst threw out a big number, like $10 billion investment. Management didn't confirm that specific figure, did they? But what was the strategic thinking behind this big push?
No, they didn't confirm the $10 billion.
Yeah.
But they laid out the rationale pretty clearly. They stressed, instant commerce isn't totally new ground for them. They already have Eli.me for food delivery and Freshippo for groceries.
Sure.
But they see the broader market as absolutely huge and growing fast, potential for maybe 1 billion consumers. Their strategy relies on leveraging what they already have. The massive Taobao user base is a natural place to integrate it.
Right, built-in audience.
Exactly. Plus, they have a mature merchant base already on their platforms, and crucially, a robust logistics network through Konia.
Did they mention how their early tests or pilots are going?
They did. Said the piloting results for their Taobao Shangu offering, which is their instant commerce service, were positive. Both the scale of adoption and the operational efficiency apparently exceeded their expectations. They really see potential in tightly knitting together this hyper-local instant delivery with their main nationwide e-commerce platform.
Synergy potential. But what about the cost? What's the impact of this aggressive investment on profitability, especially for segments like local services or even TTG?
Yeah, they were upfront about that. This is a period of aggressive investment, focused squarely on getting users to adopt instant commerce and use it frequently.
So growth first, profit later.
Pretty much. They stated very clearly this will impact the local services group's EBITDA and potentially TTG's EBITDA too in the near term. They expect profitability in those areas to fluctuate depending on how the competition plays out in this space.
Okay.
They even sort of frame the instant commerce spending partly as a strategic shift in marketing dollars, moving budget toward acquiring and engaging users in a really high-frequency purchase category.
Interesting perspective. Okay, one last Q&A point. Someone asked about the big 618 shopping festival coming up. Strategy changes there, and how might instant commerce fit in?
Right. Management confirmed they are making changes to their marketing and pacing for 618, given the current competitive landscape.
Right.
But they were cagey on the details, said they'd talk more after the campaign.
Fair enough.
But they did confirm they see big synergy potential. Specifically, planning to use the huge traffic during 618 as a major chance to push existing Taobao users to try out and hopefully adopt the instant commerce offering quickly.
Using the big sale event to drive adoption. Makes sense. Okay, so we've gone through the results, the segments, the Q&A nuances. Let's try and tie it all together. Bringing it back to the listener, what are the main takeaways here? What does all this mean for you?
I think the key message is one of focus and, frankly, aggressive betting.
Yeah.
Alibaba is clearly prioritizing its core engines, e-commerce, both domestic and international, and cloud, with AI being the massive accelerator there.
Right.
They're putting serious money into building AI infrastructure and applications. They're making a major play for the instant commerce market, leveraging their existing strengths. And at the same time, they're still optimizing the rest of their portfolio and returning cash to shareholders, which signals confidence.
So why should this matter to our listeners?
Well, because these big investments and strategic shifts really signal where Alibaba sees its future growth coming from and how it's positioning itself to compete in what's obviously a very dynamic market.
Yeah.
The whole AI story shows how quickly that tech is moving from buzzword to actual business driver, reshaping industries. The e-commerce strategy shows their efforts to, enhance monetization and keep users engaged despite fierce competition. And that instant commerce push, that's a direct shot at a huge high-frequency market, trying to integrate it right into their core user base.
Okay. So focus, investment in AI, and instant commerce, adapting to competition. Before we wrap up, maybe a final thought for our listeners to chew on, something building on the discussion.
Yeah, here's something to consider, drawing directly from what management discussed. We heard about these really significant investments in high-growth areas like cloud AI infrastructure and instant commerce. Management was very open that these investments will impact profitability in the near term.
Right, they expect fluctuation.
Exactly. So the question for you to ponder is, how should we as observers trying to understand the company evaluate that trade-off? The trade-off between these expected short-term hits to profitability and the potential long-term strategic payoff from these aggressive bets, especially in this rapidly evolving AI era. Is the long-term potential worth the short-term volatility?
That's a great question. Balancing the now versus the next big thing. A lot to think about there.
Definitely.
Well, thank you for joining us for this deep dive into the Alibaba earnings call transcript.
My pleasure.
We hope this breakdown was useful. We encourage you to mull over that final thought and continue your own exploration. Remember, this was our analysis based on the source material provided.
Indeed.
Until next time.